Hello, and welcome to the ClearBridge 2019 Outlook panel. This is Jeff Schulze, CFA Investment Strategist at ClearBridge Investments. And I'm happy to be here today with my colleagues Margaret Vitrano, Portfolio Manager for the Large Cap Growth and All Cap Growth Strategies, Scott Glasser, Co-Chief Investment Officer and Portfolio Managers for the Appreciation and Dividend Strategies, and Michael Testorf, CFA, Portfolio Manager for the International Growth and Global Growth Strategies. ClearBridge is a global equity manager with $147 billion in assets under management, committed to delivering long-term results through authentic active management. ClearBridge tailors our strategies to meet three primary climate objectives in our areas of proven expertise: high active share, income solutions, and low volatility. We integrate ESG considerations into our fundamental research process across all strategies. Well, 2018 has been quite a year as volatility has returned to equity markets, while trade tensions with China and the just completed midterm elections have driven the geopolitical debate. As we sit down here at the end of November, despite several drawdowns, the secular bull market remains intact, while our economic expansion is showing few signs of distress. And I want to start off on volatility first and foremost, because that's the new thing that's been introduced to the markets in 2018. In fact, in 2017, the biggest drawdown that we saw throughout the course of the year was 3%. And we've already had two 10% corrections this year alone. So a key question, is volatility returning back to the markets for good? Scott, did you want to weigh in on whether or not volatility is back for the rest of this cycle?
Sure. I think it's important to put this in historical context. You mentioned that last year there was one 3% drawdown. By historical standards, that's extremely rare. As a matter of fact, since we entered a period of ultra low rates after the Fed took rates essentially to zero, we've been in an extended period of time, essentially since 2008, of low volatility. The effect of very low interest rates, the effect of a reduction in the term premium in bonds has had the effect of muting volatility across the spectrum. And equities have seen very few drawdowns over the last 10 years. So we've been in a period of abnormal volatility. I think we're returning back towards more normal volatility as interest rates start to rise, as the Fed comes out of this period of ultra low interest rates or near zero interest rates. And so I think, yes, investors should expect volatility to climb from here. But I think it's only going back to a period of normal. The problem is we've been in a period where it's been so abnormally low that it feels like it's something more than it actually is. Now, as a portfolio manager, volatility, I think, is a good thing. It actually doesn't bother me. Volatility from a portfolio management standpoint gives you the opportunity to add, subtract, to do things in a portfolio that you think adds value for a client over time. Every portfolio management team generally works on what we call a secondary buy list, a list of stocks that they hope to buy someday. They've done the work, but maybe the valuations aren't what they want. A lot of times in these drawdowns, you have the opportunity to add a stock that comes down because the market as a whole comes down. It comes down for liquidity reasons, not particularly company-specific reasons. And that's when you go to your secondary buy list and you're able to add something. Conversely, you always have something that didn't work out the way that you expected. A lot of times you can swap those. Yes, you're swapping out of a beaten down stock, but you're entering into also a beaten down stock, hopefully with better fundamental expectations going forward. So volatility to me, A, is going back to normal. It should be expected. And B, gives an opportunity for portfolio managers to distinguish themselves and actually be more active, be a little bit more active.
So most investors are scared of volatility, but it's an asset for an active manager.
I thrive on volatility. I love volatility.
Michael, what are your thoughts? Do you think volatility is going to continue to rise from here?
Absolutely. I do believe, as Scott does, that volatility is to stay with us. On the international side, we have a few things more to worry, just about, not only about the Fed. We do have the slowdown in China. We do have an Italian budget discussion, and we have Brexit. So let's go from the back to the front. So Brexit, we have a withdrawal agreement decided by the EU 27 already. Theresa May agreed on that too. But the real problem is to get it through the lower house, and that will happen in the next weeks. It might not pass in the first run, might pass in the second run, but that is the deal the EU would offer, and I think there will be no alternative to that. Otherwise, we have a hard Brexit, which I personally do not believe in. So then, Italy, there is a populist government in place right now. They are on confrontational course with the EU, with the European Union about their budget proposal, and here it looks like that we come to a kind of compromise. The governments have signaled that they would not be as stubborn as they have been originally. And China, which is for me on the international side by far the biggest issue, the trade issue hopefully will ease up a little bit. We have the G20 meeting coming up, and I hope to get some positive news on it.
And you mentioned trade issues, and that's been a big source of volatility here recently. And it shouldn't be any surprise to investors as Donald Trump campaigned about reworking some of the trade agreements that we've had, and the reality has come due here in 2018. And you mentioned the G20 meeting later this week. If some sign of accord can get forged there, obviously financial markets would like that. But if there is no agreement, on January 1, the 10% tariff on the $200 billion worth of goods that went into place last month will go up to 25%. So you do have the potential for escalation. Margaret, do you think that we're going to get to some sort of resolution from a trade perspective, or is it going to continue to be a headwind for companies with international exposure?
I'm not quite as optimistic as Michael that we'll have a near-term resolution in our discussions with China. I think it's bigger and broader than just what the final tariff rate is going to be. So regardless of what comes out of the next G20 meeting, I think we're in for a period of frostier relations with China. And so for us, as we think about the portfolio, we think about direct impacts and indirect impacts. So the direct impacts are obviously higher tariffs. And most of our portfolio companies are talking about trying to pass along those higher costs to consumers. Caterpillar's talking about that. Grainger is talking about that. So that just means slight inflation and slight headwind to the U.S. economy. What I think is more troublesome and more material, potentially longer term, is the indirect impact, and that really comes through in translation impacts, the impacts of a stronger dollar, and in business confidence. The more CEOs are worried about that impact of China and those frostier relations with China, and the more that is a deterrent to them spending, that's not great for the U.S. economy. So that's the thing that we're asking our portfolio companies about.
And you've certainly seen CapEx come down dramatically from the pace that we saw in Q1. Michael, any thoughts on trade tensions?
Well, I'm not super bullish on the G20 meeting. I just have to rephrase that a little bit. So therefore, so from my point, just a little bit of an improvement, a delay of the 25% to a later point would make markets already move, because the markets are so sensitive what the relation is between the United States and China. And for us on the international side, it's even more important, because when you think about it, China was a growth engine over the last 15 years for the world economy. And in particular for the international markets, because they were the major consumer of resources over the last 15 years. In some cases, they made 50% of the entire demand for certain resources, which helps certain emerging markets, but also some of the developed markets like Canada or Australia, which are very resource driven. And then if you build up the entire production chain in China, I mean, you were buying goods from whatever, from Germany or Europe in general, from Japan, South Korea, and so on and so on. So therefore, the impact is much, much bigger. So if you were looking at United States to exports to emerging markets, is only half what Europe would be, for example. So far, the impact were not as massive, were only a few tenths of a percentage point in terms of GDP growth. But the sentiment is the critical part, right? So originally we were thinking about, because utilization rates are relatively high by now, that people go into CapEx spending. And CapEx spending actually hasn't really happened as we were originally forecasting. And I think the sentiment is what brought international markets down this year, together with currency.
Yeah, did you want to add something?
I do. I think that one of the things that the markets have a hard time with is just the unknown. Right? And so we don't know what it's going to be. And so companies can't plan. It goes to CapEx, it comes to budgeting, it goes to a lot of different parts of their business. If there's clarity on, okay, what the tariffs are and what they're not, where they're going to be, companies have a pretty good ability to reroute, whether it be manufacturing, or there are costs involved, but they can react and then and then deal with it. But not knowing what it's going to be and kind of having it play out over a longer time is the difficulty for the markets to interpret. And so that lack of clarity, I think, is what kind of hangs over the markets more than anything.
I do think that there's a natural limit to how long these trade talks will continue. If you think about Donald Trump and his re-election bid in 2020, I'm sure he's willing to accept a little bit of market volatility, maybe some economic weakness to the middle part of 2019. But as we move closer and closer to 2020, I would imagine that the risk reward or the upside downside of a trade deal actually comes a lot more in favor of having one rather than not. But if trade wars continue to escalate, it's going to hurt the earnings picture. And we've had very robust earnings here in the US because of tax cuts. But with tax cuts waning, is that going to weigh on the earnings picture in 2019? What's really going to drive growth in cash flow? Margaret, I'll start with you.
Well, you're right. We've been in a period of very good earnings growth, and it's hard to imagine, broadly speaking, that margins are going that much higher. It's also hard to imagine that we're going to have buybacks at the same level that we've had in 2018 and 2019. So I'm going to take us back to CapEx because what you really need is to see revenue growth. So you need the multiplier effect of companies spending and good consumer confidence and good business confidence to keep things moving in the U.S. I do think it's relevant to remember that tax reform, part of tax reform included immediate write-offs on CapEx, and so that made it more attractive for companies to spend. And when you think about what companies are spending on, it's not just diggers and factories. It's enterprise software, it's technology. So those kinds of investments, I think, will have a multiplier effect that I'm hopeful will help us in 2019.
Scott, any perspective?
It's interesting. If you look at the effect of the U.S. tax cuts and also the repatriation that happened and continues to happen, it's very consistent with what we saw in 2003 and then a couple of years later with the repatriation, meaning that in both cases they were front-loaded tax cuts where the benefits accrued both to individuals and corporations pretty immediately. And it lowered the cost of capital in different ways, but still had the effect of lowering the cost of capital. You saw a 6 to 8 quarter benefit, and then you saw growth revert back down to what it was pre-tax cuts. That's exactly what we're seeing here. And so you got a bump up last year. S&P profits were up mid-20s, 23, 24, 25%. You now have growth reverting back more to where it was. We've got some trade issues, which I think is probably depressing growth a little bit more than otherwise. We talked about some of the effects of that on CapEx and spending. And so you have overall S&P profit growth probably coming in right now, consensus at 7 or 8%. The question is going to be, is that 7 or 8% kind of revert down to 4 or 5% or lower? It'll still be decent growth. Don't forget, the 100-year average of S&P growth is what, 5 or 6%, something around that number. So it'll still be good growth. It's the fact that we're coming off such a high level and the second derivative, or the rate of growth, is declining, that generally markets kind of struggle with until they kind of feel comfortable with that rate. So we haven't gotten to the point where people have a better sense of, okay, what's the baseline going to be this next year? I think once we do that, people will be better off. I think the key is going to be, though, and this is, when you come off higher growth years where, I think most of us would argue a lot of the returns last year were based on this higher growth rate. You saw some multiple compression, but you saw 25% earnings growth. What will be key this year is, with a lower tax rate, what's the ability of companies to supplement that growth either with strong capital management? It could be share buybacks, it could be dividend increases, M&A, which has continued to pick up and I think will be a important theme during 2019. And then you're going to have very product-specific product stories or restructurings that are going to be attractive. So growth may be lower, but there'll be places where the growth will be either better or will be supplemented by these other factors that I think as portfolio managers, is what we have to focus in on, and that's what will kind of supplement the growth as we go to a lower growth environment.
I think personally that if we can maintain revenue growth close to where we are right now, revenue growth was 8% year over year in the third quarter, which has been above trend. If we can stay at 6 or 7% revenue growth, I think you can continue to see an earnings picture that hits expectations. And in my opinion, it all really comes back to the consumer. If you look at total cash earnings from a consumer perspective, and that takes hours of work into consideration plus wage gains, it's at 5.5% year over year, which is the highest that we've seen throughout this entire recovery. You put into effect also that the consumers are going to have $60 billion extra in their pockets next year versus this year because of tax cuts. And now that oil's down 25% from highs a couple months ago, I think there's going to be some extra money floating in the consumers' pockets that they can spend and keep revenue growth above trend. But obviously we've had a pretty big drawdown here recently. And with drawdowns, it creates opportunities from a sector and an individual company level. Now, Margaret, I know that you and Peter have been talking recently about the opportunity in information technology. What are you seeing in that space?
Yeah, well, we've been more defensively positioned in tech for a little over a year or so, but now you have certain subsectors of tech that are down more than 2x the overall market. So to Scott's point before about the volatility creating opportunity, I think the volatility is creating some opportunity in tech. And I think it's also worth noting that many of the other sectors in the S&P, whether it's interest rate concerns or consumer credit being at all-time lows and us worrying that it's gonna get worse from here, or the housing cycle potentially winding down, or inflation or emerging markets exposure, tech conveniently doesn't have exposure to a lot of those potential headwinds. So there's a little bit less vulnerability to some of the bigger issues that we're all talking about.
And I also think there's a misconception out there that tech has been fueled on speculation like the dot-com bubble in the 2000s. In fact, if you look since the March 09 lows, 90% of information technology's returns have been driven by earnings, only 10% through PE expansion.
The returns in those businesses are very, very good.
Scott, any thoughts? Any sector that you think's attractive right now?
I see opportunities across sectors. I think it's interesting. A lot of people talk about growth versus value. The growth stocks obviously have been driven by technology. Technology was the best sector, had driven returns over the last couple of years, quite honestly. I do see a bifurcation in that market, meaning it's not just technology. You just can't say technology. You really need to know where you're playing in technology. And so there's a bifurcation, so it's not everything in technology. Things with cloud, some internet storage. There are certain areas that are better markets than others in technology. But I see opportunities across the spectrum. I think what's happened is that you actually hear, which I find amazing, talk about recession now. And a lot of cyclical companies have actually sold off as if we're going into a recession. But yet when you look at the economic data, it's not there. There's no support for that argument, I would argue. Slower growth, yes. A recession, no. But yet again, a lot of the cyclical companies have sold off as if we're going into recession. And those valuations on the more value-oriented sectors reflect that. So I think that we're just going back to that, a 4.2% peak GDP back to, 2 to 3%. And those companies which have been oversold on the downside, in sectors like industrials, in sectors like financials. I think that again, you can go through sector by sector, but there's a number of opportunities. Let me ask you this question.
Okay.
I'll turn the tables on you. You've done a lot of work on the economic outlook. I mean, that's your primary focus. You've created something called the ClearBridge economic dashboard. What are you saying in terms of the outlook economically?
Well, we will have a recession. I just don't think the recession is going to come in the next 12 months.
Okay.
I think investors have this preconceived notion that an economic cycle has an expiration date or a sell-by date. And in fact, that's usually been true here in the US. But even though we're in the 10th year of this expansion, there's been several expansions outside of our borders that have lasted a lot longer. So if you look at the UK and Canada, each of those countries had a 16-year expansion from 1992 through 2008. The Japanese had a 17-year expansion from 1975 through 1992. And the Australians are currently in their 27th year of expansion. They have not had a recession since 1992. Wow. So there's not necessarily a sell-by date that you need to get out of the markets because the economy is going to roll over. But the one thing that gives us confidence that this cycle will continue to move forward is that we share similar characteristics with those cycles. First off, we have a flatter Phillips curve. What that means is that when the unemployment rate goes down, wage growth doesn't spike up. And usually when wage growth spikes up, because it's the biggest determinant of inflation, central banks tighten policy too much and end up choking off the recovery. This time around, we have a little bit of flexibility where the Fed can normalize and not necessarily go too far. We have stronger financial regulations. Because of Dodd-Frank, our banks are probably in the best shape they've been in over the last 30 years. So it's a really good foundation for the economy to sit on. And then lastly, there's no obvious financial imbalance out there, aka a bubble, that's going to pop and bring down the economy along with it. So because of those dynamics, we think that this is going to continue to last for the next 12 months at a minimum. And you mentioned this, Scott, the economic dashboard does say the same exact thing. If you look at the chart in front of you, it looks across the 4 fault lines of the economy. So it looks at financial stresses. Usually financial stresses will emanate in those markets before the economy rolls over. We look at inflation. The Fed looks at inflation, so it's something we want to be cognizant of. It looks at consumer health. It's the biggest part of our dashboard, and it's because it's the biggest part of our economy. And then lastly, we look at business activity. Business is higher, they do CapEx, and that has a multiplier effect on Main Street. And with the stoplight analogy, meaning green is good, yellow is caution, red is bad, we have 11 green, 1 yellow, and 0 red, which gives us the confidence that this cycle is going to continue for at least the next 12 months. So we've talked quite a bit about the US markets. Let's move over to the international space.
Okay, my turn again.
So let's talk about earnings trends in Europe, the UK, Japan, and will valuations catch up here to the US?
Yeah. Okay. So Scott, you were mentioning we're coming down from very, very high level. The US, without any doubt, was a rock star in 2018. So what we will see in 2019, and I just take IBIS numbers here, right, in order to be as neutral as possible. So US IBIS numbers are somewhere around the 8 level for 2018, potentially increasing slightly for 2020 for 10.
Just for clarity, those are consensus EPS numbers.
That's right, IBIS consensus numbers, sorry, yes. So, and Europe had already several downgrades over the last quarters, in particular in the last one. So, and the ECB policy overall, the stimulus in Europe started much later than in the US. So the benefits of all this QE program is coming later in Europe and in other regions as well. So IBIS is forecasting for next year actually around 10% for the Eurozone and then 9% for the year after. UK in a little bit difficult situation because of the Brexit situation is more thinking about 7%. And then in 2020 for 5%. And Japan is a very slow growing economy anyway to start with, is somewhere around levels around 7% for 2019, 5% for the year after. So the ones which are in double digit over both years are emerging markets. So that's what IBIS is saying. And I think critical to see when this whole trend is turning is looking at revision ratios. So if we have upgrades versus downgrades, and right now we're in below 1, meaning we have more downgrades than upgrades. And this is exactly what we talked about, the sentiment issue, right? I mean, all of us agree on that for sure. And it looks like that we have to watch when it's bottoming out. Europe had a really tough time over the last few months. Could there be a bottoming out somewhere? Yeah, perhaps it's possible. So, but that would be more a 2019 story rather than the end of 2018 now. So the second part of your question was, can international markets valuations catch up with the US? So that would be, I think it would be kind of wishful thinking if that is going to happen. Historically, the US was leading in terms of overall valuations. But there are also certain reasons to that. One is clearly the composition of the index, like S&P 500 has much more technology in there, much more high growth, whereas most of the other indices worldwide are a little bit, some of them are actually value oriented, some of them are a mix of this. So the other part is what the US always had over international market, they had a much higher ROE, return on equity. So and historically it was around 5-6%. That's where we are currently as well. Part of that is because it's higher growth, they have less equity, it's a growthy environment. But the other part is actually that the US really done it very smartly and levered up their balance sheet, did share buybacks, put additional debt on the balance sheet, bought equities back, reduced the equity exposure, and got a higher ROE just via that measure. So could international companies do the same? The answer is yes, it could, because when you look at balance sheets of international companies, if you look at a 30-year average, in Europe, for example, we are below 30-year average. US, we're above, clearly above. Japan, we're on historical lows. It's actually, we have a lot of company with cash, and it's sitting there and it's diluting the ROE. And with higher ROE, you get, of course, higher valuations. The other part is cash flow. US companies have managed their cash flows always better than international companies. That is, working capital management and so on. Could international companies catch up a little bit? Yes, I think that's possible too. But will there be always a gap? Yes. So, unfortunately, I have to give that to the US here, clearly.
but you're seeing an
I see progress
in share repurchase as an example. That is something that has supported the U.S. market for a period of time that you're seeing kind of more evidence of in international markets.
Because, yes, the short answer is yes. Also because the international markets had a very, very deep crisis, a deep financial crisis, and they're in general a little bit more conservative, and they need a little bit longer to improve and then feel comfortable to do share buybacks.
And Michael, you mentioned the composition of the indices being different, US being more growth-oriented, Europe, Japan being a little bit more value-centric. We actually have done some work on this, and we normalized, so you had the same amount of IT exposure in the US versus Europe. And even when you normalize the two markets, the US is trading 1 PE higher than Europe. So that would actually bode, if you do see a turnaround in Europe, maybe some potential higher valuations, broadly speaking. But one of the reasons why I think Europe and international markets could turn around is because of liquidity, right? Central banks still have their foot on the accelerator abroad. And Scott, this is a topic that you speak about quite a bit. So can you talk a little bit about liquidity? What is it, and where are we in the liquidity cycle?
Right, so liquidity is defined in many different ways. And I believe very strongly, studying financial markets, that kind of liquidity is the key to bull and bear markets. And that when liquidity is ample, in fact, that creates an enormous ability for asset prices to rise. It creates kind of the antecedent conditions or the background conditions for assets to rise. And then when liquidity starts to tighten, it creates a much more difficult environment for all asset categories. And essentially, that too tight liquidity results in a slowing of growth, basically, ultimately bear markets and recessions, or recessions and then bear markets. Bear markets obviously being a reflection of that recession. And so liquidity to me is incredibly important to monitor. More so, I would argue, than earnings, because the earnings, again, I would argue in this evolution, is earnings are kind of driven by the liquidity environment. And so liquidity is not just the Fed. Liquidity is clearly, the Fed is a key component of that. The Fed funds rate is a key component of that. But liquidity is a company's ability and access to capital. And that can be monitored through looking at spreads. Now, we have charts that look at high yield spreads relative to the 10-year Treasury. We could look at the BBB relative to, again, the 10-year Treasury. There are lots of ways in terms of spreads. You could swap spreads to look at basically how cheap is money and what's the cost of money and how available is it. Liquidity can also be the US dollar. If the US dollar is higher, right, because so many goods around the world are priced in US dollars, that's actually a high cost. And when the dollar's coming down, that provides more ample, and when it's up, that kind of becomes a headwind, again, because raw materials and energy, oil, is priced in dollars around the world.
And there's $11 trillion in US dollar denominated debt outside of our borders, so if the dollar's strengthening, servicing that debt gets a lot harder.
Right, so the dollar plays a part in liquidity, energy or oil plays a part in liquidity, raw materials do, spreads do, the Fed funds do, all these things kind of paint to whether the picture is easy or tight. So I think that's the one variable as we go forward over the next 6 to 18 months that we really need to focus in on. I'll give you another example of liquidity, which is the Fed. The Fed is actually starting to contract its balance sheet. So that's a slight negative in terms of liquidity. So when you look at the liquidity picture now, I would argue that it is tighter than it's been. We had, as we talked about, ample liquidity. We're coming out of that period of kind of easy, free, costless money, and we're going into a more normal environment. That is a tightening of liquidity by itself. You have the Fed shrinking the balance sheet, you have interest rates going up. It is not yet, in both your work and my estimation, it has not turned, again, using your analogy, the stoplight from green to red. It is maybe a little tinge of yellow, because there's, if you look at spreads have tightened, but they've tightened from ultra all-time tights.
Correct.
So they've come out a little. If you look at the Fed funds, yes, it's up from where it was, but from ultra low starting point. So you've come off an extreme back towards a normal. It's not yet a worry, but it's something to watch, because ultimately liquidity, again, I would argue, is the prime determinant of both bull and bear markets.
And this is the prime reason why we've seen some volatility here over the last couple of months.
And I think it adds to the volatility. Absolutely.
Now, you mentioned the US dollar being a very big component of the liquidity picture. Obviously, when the dollar strengthens, liquidity tends to tighten or go away. When the dollar weakens, liquidity gets more abundant.
Right.
We've seen the dollar strengthen throughout the course of this year, which is a stark contrast to what we saw in 2017. What's your outlook from a currency perspective, and how will that impact stock returns? Margaret, I'll turn to you.
Well, Michael is probably more of an expert in terms of forecasting currencies. As a U.S. large cap investor, we don't spend a lot of time trying to figure out what specific currencies are going to move what way in 2019, but we do spend a lot of time trying to think about where's our risk? How much risk do we have in Brazil between companies that have all their revenues in Brazil and companies that may get a portion of their revenues from Brazil, companies that may have that second derivative impact of changes in the Brazilian economy. So we think about it in terms of that, and just making sure that we have good diversification, that we don't have too much exposure to some of these markets that have good growth but also have a lot of volatility.
Sorry, Michael, Margaret put you on the spot there that you had some comments on the US dollar.
Right. Yeah, for us, it's the currency is super important, because at the end of the day, the total return for our shareholders is a combination of the local stock markets and the return on the currency. So 2017, we, as you said, Jeff, we had a fantastic year. 2018, we have headwinds from both sides, local stock markets as well as from the currency. So question mark is what will happen to 2019, and I just want to go through a few little pieces which could determine which direction we are going. So one is more a technical thing. So positioning in this whole risk-off mode was clearly we will go back to the US dollar from foreign currency into US dollar. We are today, in terms of long positions, speculative long positions, US dollar close to all-time highs. So there, if you are the contrarian view, you would be on the other side, right? You would be short the dollar at one point in time.
Which is where markets were coming into 2018.
Yeah. So the next step would be what happens to interest rate differentials. So somewhere at the beginning of 2019, we probably will see the peak of interest rate differentials, for example, like US dollar and euro. So we are at different stages, as I said earlier, in terms of central bank policy. So in the US, the Fed has finished QE already. We are in quantitative tightening mode, as you said, Scott. In Europe, we are still in quantitative easing mode until the end of this year, and will stop QE beginning January 1st. But that doesn't mean that liquidity will get tighter in Europe. It will actually, the central bank, the ECB, will continue to give enough liquidity, and one which I would expect in quarter one or quarter two, which is a facility for the banks, which is called TLTRO, and that will be given because the old ones are running out and they want to make sure that there's enough liquidity in the system. So I think that would be one. So from the liquidity side, I think the ECB will be easy for almost for the whole year 2019. We'll start the first little increase towards end 2019, but that is out of negative territory into still negative territory. So 2020, we will see the first time positive interest rates in Europe. That's at least what consensus here is building into the forecast curves. Bank of Japan was very easy so far, and it looks like it will continue. We will still be around the zero level, and liquidity is still ample. So we still get the green light, Jeff, on central banks internationally. And China, perhaps we'll talk about that later, but they are back to QE from tightening, and that also brought the Chinese market down because they took liquidity out of the market. Credit growth was slower, clearly slower, and is coming back with their measures they took just recently. The other part is, when I look at currencies, I look at GDP differentials. So here, clearly, the US was the rock star again in 2018. Going forward in 2019, 2020, we're converging. The US will still leading, but the gap between US and Europe or Japan will close a little bit. And emerging market, interestingly, I think could accelerate if we are not going in a totally full-out blown trade war, which I do not hope for. And then the other ones are a little bit more on the current account deficit in the US, which is pretty high. The US has to issue a lot of debt in order to finance the tax cuts, which we have seen here in 2018 going into 2019. So could that be also slightly negative for the US dollar? So the more we go into 2019, to sum up that point, is the more we go into 2019, I could see that the US dollar starting to weaken again.
So you're saying the international countries may have more financial discipline than the US over the course of the next year?
I wouldn't call it necessarily financial discipline, because also the ECB and the BOJ have widened their balance sheet quite dramatically, right?
QE on steroids.
Yeah, right. So I mean, I wouldn't call it discipline per se, but for the reasons I mentioned, I could see the US dollar somewhere in 2019 getting weaker again.
And it wouldn't be surprised to me to see a dovish Fed surprise. I mean, if you listen to the narrative of all the Fed committee members, they've turned a little bit more dovish recently. They've changed their tone. And then also, if you look at inflation, even with 4% growth in the second quarter, we've seen peak inflation. Inflation from a core PCE perspective is starting to come down. And with oil down 25% from the recent highs, if inflation is not going to be an issue in the near term, that allows them the breathing room to potentially take a pause in March or maybe in June. But US dollar obviously is one of the reasons why the US has outperformed most other global markets in 2018. What makes you optimistic about the potential returns for international developed markets and then also emerging markets like China as well? And I'm going to start with you.
It's me again. Okay, good. So let's start with positioning first of all again. Clearly, with the kind of risk-off mode, people just sold emerging markets first, Europe second, and this money went into either different asset classes, but all of them US dollar denominated. And the only country where we have really seen inflows was Japan. So being contrarian again, that would be a positive for international markets. The other part is actually valuations. I don't want to look into in terms of absolute levels of PEs or price to books. I prefer actually, because the valuations are always lower in international markets, to look versus history of the respective regions. So if you look backwards 30 years, you see that PEs, and it's similar to price to book and other measures, that Europe is roughly 7% cheap over 30-year average. The emerging markets are currently 15% cheap, and Japan, if you were doing that exercise, is actually 45% cheap. So that sounds like a lot for Japan, but it's because at the beginning we had extreme high multiples. We just came out of the bubble of Japan, which is lifting the overall average. So, but even if we were doing that over a shorter period of time, even Japan looks relatively cheap. So that is the part of valuation. So central banks, I elaborated a little bit before, so liquidity is there for the ECB and Europe. It will be the case for Japan. And the big one for us on the international side is China. So China itself has done several things over the last months. Being pretty tight in 2017 going into 2018, because they wanted to make sure that there is not too many of the bad loans that were restrictive. So 2018, with the whole trade war, they started to go the other way around. They used one measure which is called the RRR, which is the reserve requirement ratio, which basically allows banks to lend more for the capital they have. So they have done already 100 are in the making, so we are talking about 250 basis points, which is a lot. The Shibor, which is the short-term rate, which went from 5 to 3. We had like overall financial condition ratios, which are, as it's just a chart which a lot of people use, went from 75 to 90, 90 being higher, being more easy. So what it does, it should lead to higher M1 growth. It should lead to better overall growth in the economy. But in there is the banking system, and the banking system has to give more loans, and that has not really happened to the full extent as it did in the last cycles. We have seen first little steps, but going into 2019, the Chinese government will put a little bit more pressure on the overall banks and will enforce lending. So I would expect for 2019 the overall liquidity in 2019 for China to improve again. So that would be a positive, and a lot of investors are asking already, it's not really working yet, so therefore should we come with fixed asset investments, which we have seen in every single crisis. When China was on their knees, they said, okay, let's put a lot of more money into fixed assets, which are, as you know,
bridges,
railroads, and
infrastructure.
another airport and whatever, right?
Mm-hmm.
So there are actually quite some projects on the table, but they couldn't be executed because there was not enough liquidity in the system. There was not enough banks lending to them. So FII, you will see picking up in 2019 the moment liquidity comes into the system. So from that perspective, if China is doing relatively well, as it did, or hopefully better from very badly, that will also be positive for the entire international market, as I discussed before, because of the dependence. So then the next part would be, how do actually the different parts of the economy do? Consumers are doing actually fairly well everywhere in the developed world. So we're talking in Europe, for example, we have already shortage in terms of skilled laborers in Germany and other Northern European countries. We have wage growth around 3+% already. Japan, we are so tight in the labor market that applicant ratio to open jobs is skyrocketing. Also, even in Japan, we see wage growth. So the consumer is actually doing fairly well and was never really that leveraged over the last years. So that's a good thing. Then we have the corporate sector. Corporate sector is also doing relatively well because they have not put that much debt on it. And as I said before, we're below 30-year average in Europe, and we're at rock bottom in terms of leverage, meaning actually cash in Japan. So from that perspective, the base is actually relatively good. What we need is, clearly, we need better sentiment. And sentiment, I think trade could be one, and hopefully we will postpone the kind of 25 or we'll reduce it a little bit. Although I do agree with you, Margaret, will be on technology, the fight will continue. I mean, and that the Americans will push for patent preservation and protection. So I mean, I think that will continue for many, many years to come. But what I'm talking about, which should lead to a little bit better sentiment, is the edges that they come for certain goods which they could agree on. I mean, that's what I would like to see.
Margaret, any perspective from a multinational with EM exposure?
I think Michael summed it up nicely when he said it really comes down to GDP differentials, because when I think about investing in China or investing in Brazil, some of these emerging markets, they obviously have higher risk profiles and they're obviously more volatile, but it's hard to fight with 6% GDP growth. And so even if China slows a little bit, it's still a lot better than the US. And so I think you want to be prudent in terms of managing the risk of that, but I think there is some good long-term value to investing in these volatile but faster growth through the cycle kinds of markets.
And one key component that, Michael, you had mentioned that I think is underestimated by participants right now is Chinese stimulus.
Yes,
through both
that's
monetary
true.
and fiscal levers. Believe it or not, they've done almost 40 measures of easing throughout the course of 2018. 40. It's a big number.
I feel better with them on my side.
And the last time that they did stimulus like this was 2015. It took a little bit of time for the rubber to hit the road, but of course, in 2016, international markets took off and they never looked back. So I could very easily see a scenario going into early next year where that stimulus starts to work its way into the system, global growth picks up, and financial markets will lead higher.
I thought I heard kind of a, maybe not explicit, but implicit argument for buying international growth on my left here. I think he was making the case for it, and it makes sense.
Yeah.
That's what I heard, at least.
Yeah.
Well, I think we're up on time. I appreciate you all joining me in the studio here today, but I want to just leave the viewers with one key takeaway. If there's one thing that you want the viewers to think about, what's likely to transpire or keep in front of their mind for 2019, what is it? And Margaret, I'll start with you.
I would say that from our view, we are in the later stages of the economic cycle, but that doesn't mean that parts of the market can't continue to march higher. So when you think about your portfolio, think about diversification and think about not having all of your eggs in one basket, because I think that will serve you well in a market that's probably going to remain choppy and remain volatile, but can march higher.
Scott?
I would focus on, in the portfolios, I think that I'd agree, we're in the later stages. Per your comments, it doesn't mean that can extend for several more years. I don't think there are any signs of a recession. Slower growth, yes, but a recession, no. I think liquidity is something, as I mentioned, we need to continue to watch. But I think it's fine right now. And in fact, as you heard, global liquidity is actually is either expansive or becoming, in the case of China, more expansive, and that's helpful as well. When I think about stocks and I think about the portfolio, I think that we are in the stage where, there are certain periods of time where quality-oriented stocks do better and quality-oriented stocks do less well. I think we're in that former stage where quality, as you come towards the later stage, when you've got these issues, when you've got more volatility, I think there is a preference for quality. And so my message to investors is stay diversified, as Margaret said, but also kind of lean towards that quality-oriented portfolio. It's not the time, per se, to have the pedal to the metal. It's not 2003, it's not 2009, where things are cheap across the board and everything's going up. I think there's much more separation between the good and the bad and those that are actually performing and not. And so everything doesn't go up per se. The market will go up, but everything doesn't go up per se, and that I would be leaning towards consistency of ROEs, consistency of balance sheet. So I think quality of balance sheet as we get in the later stages matters more. We've seen that more recently with the correction, and quality overall. So my comment would be lean towards quality in terms of your both stock and portfolio selections.
And know what you own.
Always.
Michael?
All right, it's always good to be third because I don't have to talk that much. So, Margaret, thanks for diversification. That also applies actually for international.
Over to you, Michael.
So it's not only in terms of sectors, but it could be also in terms of regions and currencies and so on. And I know that a lot of investors have a bias towards home. I mean, that's also understandable because, I mean, their obligations are normally in US dollar. But, putting a little sliver of international here and there wouldn't hurt for the reasons which I was mentioning. Scott, I do agree with you that quality is probably the main focus if we're in the later part of the cycle. I think that also helps for us on the international strategies because we have a quality focus. And I think what investors have to, in these kind of volatile times, have to be very valuation focused. So, and what we try to do in our international strategy is that we have a very strong valuation approach to growth. So we're not want to overpay for growth. If the stocks are coming down, gives you buy opportunities, and that's what we are trying to do. And I think what investors should do as well, using some of the dips in quality stocks and focus, even if the sentiment is sometimes a little bit bad, but that's normally the time when you look at the stocks.
And maybe the one key takeaway that I'll say is that this is the 6th drawdown that we've had during this expansion of 10% or greater. So it's not the first time that we've been here, but we're historically entering into a very good time frame from an equity market perspective. So if you look at the year following the midterm elections, going all the way back to 1950, we've had 17 of those years. 17 for 17 times, the equity markets have been positive for that 1 year following the elections. with your average one-year return of 15.3%. And the reason why you've seen outsized gains during this year is because you've never seen a recession start in year 3 of a presidential cycle. And 2019 is year 3 of Trump's presidential cycle. So just not to be too bearish, remember that the fundamental picture is still intact. U.S. growth is slowing, earnings will slow, but it's going to be above trend, and then you have the potential for global growth reaccelerating over the course of 2019. Well, great. I want to thank all of you for joining me here in the studio today. I want to thank all of you for tuning in to the 2019 Outlook. Hopefully we're able to give you some perspective on what's likely to transpire over the next 12 months. From ClearBridge Investments, we hope everybody has a safe and happy holiday season and New Year's, and we look forward to having you back here sometime soon. Please note the following. Past performance is no guarantee of future results. The opinions and views expressed in today's podcast are of the individual speakers and not intended to be a forecast of future events, a guarantee of future results, or investment advice. Any statistics referenced have been obtained from sources believed to be reliable, but the accuracy and completeness of this information cannot be guaranteed. Neither ClearBridge Investments nor its information providers are responsible for any damages or losses arising from any use of this information.